I talk a lot on this channel about different real estate markets in which you can invest. Which market you choose actually has a very big impact on your returns. But the truth is that most markets work for real estate investing. It just really depends on your personal strategy and what you're looking for out of your portfolio. Other people want appreciation. Some people want to find a market that's more up and coming, while others prefer a less risky, more established market. Today, we're going to look at two markets that may be very good for your strategy. They're two of the biggest markets in the country: Chicago, Illinois, and Houston, Texas. We're going to dig into tons of different measures to compare and contrast these two markets. Even if you're not into these particular markets, that's totally fine. And this video should still help you learn about which metrics you should be tracking and how to think about the different inputs that go into selecting a market. If you are actually interested in these two markets, or really any market at all, make sure to get an investor-friendly agent. It is the number one thing that you can do to help build out a team in a new market and ensure that you find great deals. If you want an investor-friendly agent, go to BiggerPockets.com/agents. When you're there, you can just put in some basic information about yourself and you'll get matched for free with really good investor-friendly agents. So go check it out. Okay, so our two markets that we're going to be comparing today are Chicago and Houston. And what I'm going to do is the normal process that I follow myself for analyzing a market. And that means I start sort of with the broadest, most macroeconomic trends, and then I sort of drill down more and more into some of the housing market metrics that help me understand sort of what's going on the ground in that market today. So let's start with population. As I said, these are two of the biggest markets in the country. Chicago is the third biggest city, and Houston is right behind it with the fourth biggest city in the country. But that is sort of where the similarities end, at least in terms of population. If you look at this chart, it shows population growth year over year by metro area. And as you can see, Houston and Chicago have very different profiles here. Houston has been growing very steadily and well above the national average for as far back as this data goes. Now, when we look at Chicago, you can see that for, back in the 2000s, things were going okay. But for the last 5 or 10 years, the metro area has actually been declining in terms of population. And this really matters, right? Because housing prices and rent prices all come down to supply and demand. And the reason we as investors want to look at population is because when people are moving to an area, or a population is just growing naturally through births, that increases demand naturally, and that helps put upward pressure on prices, on rent, and helps bolster your returns. This shows a very big difference between these two markets. And these are just one data point that we're going to get into all sorts of ones, but this is an important one for you to look at. Houston is growing and the Chicago metro is not. I should mention that I looked into this and the Chicago downtown area is actually growing, but the data here is on a metro area, which includes the suburbs. So Chicago suburbs are declining, but the city itself is actually growing. So just something for you to think about. The next sort of macroeconomic indicator you should always look at is the economy. And there are a lot of different ways you can look at the economy. You can look at employment, you can look at wage growth. Personally, just for the purposes of this video, I'm going to do a simple one, which is the unemployment rate. So if you look down here, you can see that Chicago and Houston actually have pretty similar unemployment rate now. Chicago is at 5%. And Houston is at 4.5%. And historically, these are pretty good numbers. They're not spectacular, but I think it's important to note that both of these markets are above the national average. Right now, as of this recording in the middle of December, the national unemployment rate is about 3.9%. So both of these are above that. That's not necessarily a terrible thing, but it is another data point that you should pay attention to. Before we move into the housing economics and some of the housing metrics, I just want to mention a couple of other things that I uncovered during my research into these two markets. A couple other things to take note of is that Texas, where Houston is a no income tax state, and that some people really like that. The government still does have to collect taxes, and so they compensate for the no income taxes by having some of the highest property taxes in the country. In Harris County, where Houston is, the tax rate, the property tax rate, is about over 2% of the assessed value. The national average is 1%, so it's basically double. Chicago is lower than Houston. It's 1.5%, but still relatively high. So again, these are just data points that you need to think about when you're aligning markets to your strategies. These have higher than average taxes. Houston's higher than Chicago, but both of them are higher than average. The other thing is about Houston. I actually have invested in Houston. And so one thing I noted when I was doing my diligence there is that Houston is in a floodplain. You remember they had a really horrible flood there a couple of years ago. And insurance costs can go up because of that. And it's also important to just make sure if you are going to invest in that market, you are aware of where you are in the floodplain and make sure that you're properly protected. So those are some of the things that I dug into and uncovered about Chicago and Houston when I was just looking into what's going on in these markets. Next, let's move on to the housing market and see what's going on there. First up, we will look at the median sales price. And you can see this is where they sort of converge again. And you see that they are relatively similar to one another, at least in terms of price, both around $310,000, $325,000 for the median home price. And this is obviously important because the budget and where you can afford really matters. But if you're deciding between these two cities, for example, comparing and contrasting, it's pretty similar in terms of price point. But for me, what I actually care about is looking at the trends, right? Are things going up or down? And so let's look at year over year growth rates for these two cities, and you'll see something very different. In Chicago, we saw prices really decelerate about a year ago, which happened almost in every market in the country. But since then, since sort of the first or second quarter of 2023, it has shot back up, and Chicago is growing really solidly at around 5% right now. And that is really nice. You know, it's not the 20% that we saw years ago, but to me, 5% is normal growth rate. That is a very sign of probably a healthier market than we've been in for a while. And that is sort of consistent with what we see across the Midwest. Those markets tend to be doing pretty well. Houston, on the other hand, decelerated last year, just like most markets, but it has remained below zero in terms of growth rate. So that means it has declined year over year for most of 2023. That said, it is not a very significant correction. It's, down 2 or 3% most of the year. The most recent reading shows that it's rebounded and it's down less than 1%. But as you can see, it's somewhat flat, let's call it, for Houston, whereas Chicago, price-wise, is growing. Now, let's look at forward a little bit because prices are a lag indicator, right? We only can look at prices for what happened previously, but we want to sort of understand what might happen in the future when it comes to prices in these markets. And so a couple of indicators that I look towards are inventory. This is really a measure of supply, right? We talked about demand earlier in terms of population growth, but we also want to understand how many things are for sale on a market because when supply is really low, that tends to put upward pressure on the market, where when supply is really high, that puts downward pressure on the market. And again, we see pretty big differences between Chicago and Houston here. So Houston's inventory has been relatively flat. That's not a bad thing. That is totally fine. When you look at Chicago, you see that inventory is down more than 20% year over year. Now, whether that's good or bad depends on whether you're buying or selling, but I'm presuming watching this video that you are looking to buy. And what that means is that you will probably have a competitive market. There's not a lot of things to buy. So everyone who's looking to buy a property is going to be competing for very few homes. And so you're going to face a more competitive market. But low inventory also tends to be a lead indicator for price growth because if there are a lot of people chasing few homes, that tends to bid up the price. And so maybe that 5% that we're seeing in Chicago growth could continue. And that would be really good for anyone who invests in the market today. Now we can dig further into inventory and look at new listings, and you'll see that these are relatively similar right now. And you can see that they're basically about flat year over year. And this just means that people are listing about the same amount of homes as they were a year ago. Now, if you're curious how people list the same amount of homes, but inventory is going up, that's a very good question. And basically, it comes down to how quickly properties are coming off the market, right? If the same amount of people are listing their homes, but they are coming off the market quicker, that means that there's less average homes for sale at any given point, which is exactly what's going on in Chicago. Meanwhile, in Houston, same amount of listings, and we see that inventory is relatively flat. So that means the properties are probably selling in about the same amount of time that they were a year ago. So hopefully, as you can see, as we're going through these metrics, you can see there's no right or wrong answer. There's no market that is better than another, but they really help to compare and contrast these two against each other. So you can choose which market, maybe you want to choose one of these two, but whatever market you're looking at, these metrics can help you figure out which ones are right for you. Chicago has a higher median rent of $1,950 per month. Houston has only slightly lower at $1,800 per month. But I think if you compare these two things, if you look at this a little bit deeper, it's important because Chicago actually had lower home prices just by a little bit than Houston, but it also has higher rent. So that means it has a better rent to price ratio and is more likely to generate cash flow for an investor, particularly when you also look at the lower insurance and the lower taxes in Chicago. So that could be something that you care about. Houston's median rent and rent to price ratio is not necessarily bad. It's just a little bit lower than Chicago. So when I look at these two markets and try and think who would be a good match for these two markets, well, the benefits to Chicago, it has slightly better cash flow prospects than Houston, at least right now. And when you look at housing market conditions, it looks, at least today, like it is poised for growth. It grew 5% over the past few years. Inventory remains low. Demand is doing pretty well. And so it may continue to grow into the future, and that could be really good for certain investors. Meanwhile, when you look at Houston, the housing market conditions are relatively flat. There's nothing really wrong with flat, but it is just something that you should be thinking about. But when you look at Houston's sort of long-term fundamentals, like the better unemployment rate, the very strong population growth, it has a very nice diversified economy as well. When you look at that, that might be better for you if that's the kind of investment that you're looking for. So that's what we got for you today. Hopefully going through these metrics help you figure out a market that is right for you. As I said at the top of the show, I truly believe this, that most markets work. It just really depends on if it works for your particular strategy. Some markets are great for flipping, some are good for short-term rentals, some are good for long-term rentals. And so you have to go through these exercises of looking at the metrics, digging into the numbers to figure out if the market you live in is right for your strategy, and if not, what market might be right for your strategy. Once you figure out what market you want to invest in, make sure to find an investor-friendly agent. As I said before, we make that really easy at BiggerPockets. Just go to biggerpockets.com/agent to get matched for free. Thank you all so much for watching this video. For BiggerPockets, my name is Dave Meyer, and I'll see you next week.